Around 3/4 of all adults have some form of debt. Yet only around 40% of adults understand that. And that's based on a self-assessment. So the real number in a quiz might actually be much lower. And additionally, the people that best understand debt are oftentimes the people that have either already used debt well in the past and are now debt-free, or that currently have debt but manage it well. So it is very important to consider that there is a large number of people that have that but really don't understand that well. So in this video, you are going to learn about the 10 metrics that will help you to better understand the subject of debt and to understand your specific debt. So let us get started with the first one. The first metric of debt is secured debt. Secured does not mean it's safe for you to borrow that money or it is safe for the lender to borrow you that money, but rather it means that when you borrow that money, it is being borrowed against an asset of yours. Oftentimes, the asset in question is the thing for which you borrowed the money. So a perfect example for this is a car loan. If you go and get a car loan to buy your car, then this is almost always a secured debt. And the collateral against which it is being held is the car which you're purchasing with the money you're borrowing. So if you default on the loan, the lender can seize your asset, sell it, and then recuperate some of the money that you're owing them. This is called secured debt. And what has to be said is that oftentimes, or almost always, secured debt has fairly low interest rates compared to other forms of debt that we'll talk about later during the video. So let us talk about the opposite of secured debt. The opposite is metric number 2. This is unsecured debt. Unsecured debt is quite the opposite of secured debt. There is no collateral against which you are borrowing. A perfect example for this would be a credit card. And with the credit card, you will be able to spend money, but you need to repay it, because if you don't, then there might not be an asset which they can seize to get their money back, but credit card institutions have the option to sue you and come for their money that way. Now, of course, this is a more lengthy and complicated process than just seizing your car if you default on the payments, but it's still a way how they will get their money back. So just because the card isn't against your assets necessarily doesn't mean that they cannot get that money from you some way or another. And particularly if you owe a lot, credit card companies will come for you and make sure that they get their money from you. With unsecured debt, you almost always have very high interest rates. Yes, there are credit cards that have 0% interest on them, or 3 or 5, but oftentimes, not always, but oftentimes there's a catch somewhere in the fine print where if you don't make your minimum payments, then the interest balloons to 30% or so on and so forth. So these forms of advertisement, because that's what it is, they advertise with a 0% interest rate, does not necessarily mean that this is the only thing that can happen. It really depends on the card and the specific contract. But as I said, typically unsecured debt comes with very steep interest rates. We're talking 20% plus. And this is, of course, horrible, and a horrible use of your money to be spending it on paying interest on a credit card. So that's typically a great way to invest your money, is to pay down your high interest debt, because almost no investment you can make on the open market is going to get you that kind of return. And so this is called unsecured debt. There's no collateral against which the money is being borrowed, and that comes at the expense of high interest rates, but it is much easier to get unsecured debt than to get secured debt, because to get secured debt, you need something against which you can borrow. or need to purchase something against which you then borrow. So let us move on to metric number 3. Metric number 3 is revolving debt. Revolving debt is most commonly found in credit cards. Yes, it does exist in other forms of credits and loans, but most commonly for the average consumer, it is associated with credit cards. Now, what is it? I'm sure you've already encountered it, even if you haven't encountered it under this name. What it is that every month you have a spending limit, or there's a spending limit on your card, depending on how your card is structured and where you live in the world. And with that, once you have spent your spending limit, you need to repay that money because you didn't spend your own money, you spent the bank's money, and they want to have it back. And they give you a certain time frame within which you can pay it back without interest. And if you pay it back after that, you need to pay hefty interest. So with that, once you have paid back the money, hopefully without interest, you then have that same credit available again. And this is continuously throughout time. Revolving debt is not close-ended, it is open-ended. And so you can use it today, you cannot use it today, you can also use it 10 years from now. It really depends, and it's just an availability of funds, but should be treated carefully. Particularly young people or also people that have never before encountered the credit card concept tend to abuse credit cards or not use them in a way that is advantageous to them, where it actually will end up hurting them tremendously. The opposite of revolving debt is going to be the next metric that we look at. The next metric is installment debt. Now, installment debt is most commonly found in something like a mortgage. And here you have installments that you pay every week, every 2 weeks, every month, depending on what your contract says. And with that, you have a closed-ended form of debt. There is a definitive date on which you are done paying your installments. It is important to say, though, that these installments don't necessarily always have to be the same. This depends a lot on the next 2 factors that we are going to talk about. But before we talk about them, one more thing that should be said about installment debt is that typically installment debt comes with lower interest rates than revolving debt. With the revolving debt, you have an availability of funds that you can spend as you like, and because of that freedom that you're given, both in when you spend and what you spend on, you tend to pay higher interest rates. And with the installment debt, it is almost always the case that you have purchased something and that this purchase is what you are then paying off in the installments, and that in case you can't pay it off, that they can seize that asset. So almost all installment debt is secured debt. This has changed in recent years, where you do have installment debt through payment service providers, where you buy a thing and then you pay it in multiple payments. But that is a more modern form of installment debt. Traditionally, installment debt was mainly used for secured forms of debt. And even today, most large purchases that are being made with installment debt are secured forms of debt. So let us move on to the next metric that we're going to look at. The next metric is fixed rate. With a fixed rate, you always have the same interest rate that you pay. Now, this can apply both to a mortgage, it can also apply to a credit card. So fixed rates can both happen in a secured and an unsecured form of debt. And with the fixed rate, it does not mean that you always pay the same amount of interest, but just the same percentage of interest. This is important to differentiate. And also with the fixed rate, you oftentimes pay a somewhat higher interest rate because as a consumer, you get a level of reliability and safety as to what your payments are going to be. And with that, the lender says, well, we would like to charge you a little bit extra because we do not know what the economic situation will be like a year, 5 years, 10 years from now. And in case that we need to borrow money ourselves at a higher interest rate than what we're borrowing the money to you at, we would like to have a cushion of safety. But also you pay extra for the convenience. But typically the difference between a fixed rate interest rate and the next form of an interest rate tends to not be tremendously huge. And as I said, fixed rate interest rates provide you with a level of predictability and certainty. One thing that needs to be said though is that how, particularly in the space of mortgages, fixed rate mortgages work depends heavily on where in the world you live. So for example, in North America, the maturity date of your loan overall, for example, for a house purchase, does not have to be the same as the term length of your fixed rate. So you might have a maturity date on your mortgage of 25 years, which is when you pay off your house, but you might only have a 5-year fixed mortgage rate because after that you need to then get a new fixed mortgage rate. Whereas in Europe, oftentimes, if your maturity date is 25 years from now, then you will take out a 25-year fixed mortgage. Again, these things depend a lot on where you live, and you can also find the North American version in Europe and vice versa. And you can shop around to find something that suits you and your financial situation. But of course, typically, when you get a longer fixed rate, such as a 25-year fixed rate for your mortgage, you pay even more in extra fees because the bank cannot predict what the economy will be like 20 or 25 years from now. And so you might be making a really good deal in case that interest rates 20 years from now are tremendously high. With that, we are moving on to the opposite of the fixed rate, which is variable rate. The variable rate is, as I said, the opposite of the fixed rate. The variable rate adjusts with the market rate of borrowing money. So, for example, if you borrowed money from a bank and with a fixed rate, you would have a fixed interest rate of 3% per year for 5 years, then that's fixed. With the variable one, the bank says, well, whatever we borrow money at, we'll take that amount plus whatever we would like to charge. Typically, the amount on top that they charge you is the part that stays stable. So as an example, let's say the bank borrows money at a 1.9% interest rate and then borrows it to you at 2.9%. This means the bank charges you an extra 1% on top that you have to pay in interest to the bank. That is their profit on this transaction. Now, if the market value of borrowing money changes and the bank now has to pay 2.1% interest on the money that they borrow, then your interest that you pay to the bank also goes up. So now you're going to pay 3.1 because again, the bank will charge you that 1% on top. And this has to be considered with a variable rate. Variable rates do typically come with a lower interest rate than a fixed rate, but you need to be careful of an economic outlook. Are you currently in a situation where interest rates are historically low and you can expect them to get higher again in the future? Then a fixed rate is probably better for you to get. If currently interest rates are historically high and it can be expected that they will drop in the coming years, then having a variable rate is probably the safer bet for you because that way you can then wait until interest rates go down and then at a low level lock in a fixed rate. So this is something that you have to decide based on your lending capacity because oftentimes with a variable rate, you do get a higher lending capacity. And you also need to decide it based on the current economic situation and the future economic outlook. So make sure to not make this decision lightheartedly, because it will impact your finances for many years to come. Another thing that has to be pointed out and that I would like you to be conscientious of is that with variable rates, there have been examples in the past of lenders not adjusting the rates for increases and decreases at the same speed. So, for example, if their own cost of lending increased, they would increase your cost of lending from them in almost real time. But if their cost of lending decreased, then your cost of lending from them did not decrease in real time, so that they oftentimes actually got more money out of you than they contractually were eligible to get from you. Proving this is very complicated, very time intensive, and then getting the money from them is even more time intensive. So do be cautious that you work with a bank that you trust and that has a good track record in this department and does not screw you over and take more money from you than they should. So just be cautious of this. Having talked about variable and fixed rates, let us now move on to the next metric of debt. The next metric is short-term debt. It is very important for you to know if your debt is short-term, because the amount that you owe a loan does not tell you how much you have to repay every month. Yes, your interest rate heavily influences how much you pay back, but the maturity date of your loans, meaning by when you need to have them paid back, heavily influences your monthly payments. If you borrow $100,000, it makes a huge difference if you need to pay back that money in 1 year or in 30 years. With that, you need to understand exactly how long do you have to repay. Do you have the option of paying back the money faster? If you do, does it come with a penalty? Do you have the option to pay back the money more slowly? What are the consequences of that? Understanding the length of borrowing time of your debt is hugely important. This is very important to private consumers, but even more so to companies, because to them, they typically need to indicate on their financial audits whether debt is short-term or long-term. And even for private individuals, it is very advisable that you precisely know not just how much you're paying, but until when you're paying that. A lot of people, they know their monthly payments, but they don't know when their final payment will be. So seeing, well, it's $100 a week, that could be very good if you're only paying that for 4 weeks. It could also be horrible if you're paying that for the next few years. So the length of your debt is very important to know. Put it in your calendar. Make sure that you've noted by when your debt is paid down. By then, you are car loan debt free. And by then, you are mortgage debt free. These are all things that you should know. And one other thing that needs to be said is you do need to know if, outside of you choosing to change the length of your debt terms, your lender can change the lengths of your debt terms. Because this does exist, where you borrow money and you borrow it for 30 years to pay down a house, but then due to economical circumstances, the bank says, well, now it's going to take you 60 years to pay back the money, which of course is a huge threat to your retirement plans. So it is important that you understand both what you are allowed to do in terms of modifying the length of your loan, and that you also understand what the lender is allowed to do in terms of modifying the length of your loan, and that most importantly, you understand when your loan is going to be over, so how long is it taking? Because the opposite of the short-term loan is, of course, the long-term. Long-term debt is typically something like a mortgage or car payments, or if you have a lot of credit card debt, then also oftentimes credit card debt. These are all forms of long-term debt. And with long-term debt, you can really make use of financial strategies to save yourself money. So, for example, if you manage to pay back that money faster than you originally anticipated, you can heavily cut down on the interest that you need to pay. It makes a huge difference. Even if you just make one extra payment per year, it makes a difference in how much interest you are going to pay over a 25 or 30-year term. And keep in mind that when your term length gets longer, of course, the interest that you have to pay starts to really balloon. So the difference between a 25-year mortgage and a 35-year mortgage in interest is tremendous because you are borrowing money for an extra 10 years. So keep that in mind, that time is hugely important in the realm of finance and how much you're going to owe someone. So make sure that you check, is my loan short-term, long-term? How can I modify it? How can the bank modify it? For what reasons would it be modified? These are all things that you need to know about your mortgage, your debt of any form. So let us move on to number 9. Callable debt. What is callable debt? Callable debt means that even though you might have a contractual maturity date for your loan of 25 years, the bank has the ability to seize the money at any time they want. So if they want to have the money back after just 1 month, you need to pay them back the money. And if you can't, they are allowed to seize the asset against which the callable debt has been secured. Again, most of the time, callable debt is secured against some form of asset. Here comes the good news. Callable debt is almost always used in a commercial environment. Very few private individuals will ever encounter callable debt. Yet, it does exist in a private setting where there are specific forms of lines of credits and loans where the bank or lender has the ability to seize the money at any time or request the money at any time, and then if you can't repay, seize the asset against which the money has been secured. It is rare, but something you should be aware of, and just because it's written in the contract doesn't mean you can't get it worked out of a contract. Sometimes this is a standard clause that will be in there for certain kinds of credit lines to a borrower. But if you have not yet signed the document, you can potentially negotiate that this is not written in there. Of course, this might influence interest rates because the bank therefore sees you as a higher risk candidate typically. So just be aware of callable debt and what it can do to your financial future, because most people would not be able to just suddenly repay the money that they owed on their house or their car or whatever else they owe money on, but rather they need the slow and steady way of repayment. What is the much more common form of debt? Well, the opposite of callable debt is non-callable debt. Non-callable debt is the form of debt that most consumers encounter and are aware of. And it is the one that most of the time you will use. Meaning that whether the lender needs the money today or in 20 years, they cannot get the money from you before the contractually agreed upon date. They cannot just say, well, I'd like to have the money today, so give me the money. It doesn't work. And it gives you a lot more security. One thing that does need to be pointed out is that while this is much more common, it is still important that you are aware of what the lender is legally allowed to do based on the contract. And also that you, if you are a business, are aware of the risk factors associated with callable debt. because unfortunately there have been historic examples of lenders being able to call debt at any given time, the borrowers not being able to repay, and the lenders then seizing the borrower's assets, which oftentimes included patents, where the lender from the beginning had the intention of calling the debt, knowing that the borrower couldn't repay, and then seizing the assets and the patents and making a fortune with that. So just do be careful, if you are a business owner, of the legal implications of callable debt. And make sure that you save yourself from potential risks by negotiating contracts. Keep in mind, contracts, until they're signed, can always be negotiated. So, to recap everything, make sure that you always know whether your debt is secured or unsecured, whether it is revolving debt or installment debt, whether it is fixed rates or variable rate debt, whether it is short-term or long-term, and whether it is callable or non-callable. So these are the 10 metrics belonging to the 5 categories of debt. Of course, there's a lot more that goes into a discussion of debt. A risk assessment matters in the interest rate. The interest rate itself also matters. Is it high or low? But these are 5 overall categories and 10 metrics that you can use to assess your debt. So where does your debt belong? This way you can categorize your debt and can, for example, identify your mortgage is a secured form of debt. It has installment payments. It has a fixed rate. It is long-term and it is non-callable. Or you could also identify you have non-secured credit card debt. It is revolving debt. It has a fixed rate. It is short-term and it is non-callable. So these are things that you can do based on your contracts, your financial situation, to then be able to better understand each of your debts and what opportunities and threats they pose on your life. Because debt can be a tool, but it can also be a death trap. So make sure that you do not suffer from not understanding your debt properly. I am sure that this video helped you to better understand debt and be able to categorize your debt. Do make sure that you categorize the debt, because it will greatly empower you. I wish you a wonderful day wherever you are. Take care. Bye. Thanks for watching. Please like, subscribe, and comment. And if you want to keep on learning, click on one of these videos.